All right, so let's talk about some new opportunities. We get a lot of questions this year. I think we've got more questions about non-qualified mortgages than any other. Candidly, I've known about these programs for years. I really didn't start seeing a lot of requests or a large need for them until last year or two, which is interesting. So let's just kind of unpack some things here. So here's me. Mike Belfor, been in this industry 22 years, opened the first Bay Area branch, actually the first retail branch for American Pacific Mortgage, because before then, they were working through DBAs, meaning there's other institutions using their underwriting. So that's our first retail branch for this company. Been here 15 years, ranked within the top 1% of mortgage originators nationally. I have a great team. I really care about doing all we can to help people become either first-time homebuyers or investors and really finding the right products for them, which is why I think this presentation may help because it's some out-of-the-box type thinking. Um, so our session focus, of course, is what is non-QM? Benefits of non-QM, key features of non-QM, solutions for non-traditional borrowers, and of course, we'll do live Q&A. And I'm recording this. I'm not going to record that part. If you have questions and you get the recording, simply just shoot me a message. I'm definitely here to help answer these questions for you. And yeah, I have a ton of resources I could send to you as well. All right. So, what is a non-qualified mortgage? Non-qualified mortgage is a loan for buyers who don't qualify this with the strict or meet the strict guidelines of a qualified mortgage set by the CFPB. And of course, Dodd-Frank, which is a law that was passed 2008, put into effect 2010, changes that we saw in the industry, creating what we call qualified mortgages. So it allows for non-traditional income calculations and recent credit events for those that may not be able to qualify with those particular guidelines. So the benefits of that product, of course, is accessible. It's a broader range for a lot of folks, allows them to acquire financing whereas they would not be able to otherwise. They are flexible terms. Non-qualified mortgages offer alternative ways to verify income. So this is like bank statements. There's asset depletion, where if they're a high net worth individual, we use asset depletion to qualify them. Profit and loss statements, they're loan programs that use the rental income of the property to help qualify. There are also non-ratio programs where if they're not showing much income on paper, but they're doing quite well and they're writing a bunch of stuff off, whatever it may be, there are programs to help qualify them as well. So it also allows for unique property types, investment properties, second vacation homes, condo hotels, TIC, non-warrantable condos, which is a big one that we saw in 2025 due to SB 326. And I have a whole thing on that if you're interested as well. Simply ask the question later or shoot me a text or email. Happy to share the articles and things I put together for SB 326 in condos in this market. All right, so key non-QM program features, expand ratios, 50% debt to income ratio, departing residence options. There are various terms with interest only items. There are terms with no mortgage insurance. Obviously, usually no mortgage insurance because mortgage insurance is something I'll follow. An FHA home loan or a conventional Fannie or Freddie Mac loan, flexible income sources, and manual underwriting. So a recent history of non-QM. So it emerged after the financial crisis of 2008, as I alluded to earlier, requires income and asset documentation to support the borrower's ability to repay. It's different from the no-doc stuff that we saw. It's not subprime. We still qualify clients. And in fact, we've had issues with some clients where there's still a difficult way to take it from one investor to another investor to help consummate the transaction. So guidelines are still apparent. It's not the Wild West that we saw with some of those crazy loan products prior to the financial uh, crisis and a great recession that we saw in 2007, 2008. So it is becoming more important for borrowers who don't qualify for traditional loans. So it's a resource for them, right? It's a way to get things done for folks that are looking to purchase, but documentation wise, it's a little bit out of box, if you will. So here are some stats from 2022, and they're relatively the same. And today, and we're starting to see, of course, year-over-year changes here, but the average credit score is 771, average down payment 24%, average debt to income ratio 37, and of course, volume increased by 31%, right? So, and these are bank statement and debt service ratio income types by majority. So, a bank statement loan, self-employed borrowers and small business owners. What is the bank statement program? The bank statement program allows for self-employed borrowers and small businesses to use alternative document for income. In lieu of tax returns, bank statements are basically used. So we'd essentially use your client's bank statements to help qualify for them for the product, especially if they're in a state where they write a lot through the business, if you will, or tax returns don't show qualifying income, but yet their bank statements certainly show the deposits and wherewithal to actually help qualify for that particular purchase or refinance. So the features of this program is no IRS tax documents are needed. It's 12 or 24 months. Bank statements, income is calculated within 24 to 40 hours. We have an income dex to help with that. Up to 90% loan to value with no mortgage insurance. Loan amounts as low as 100,000 up to 3 million. And I believe we have exceptions to get above that as well. Owner occupied second home and investment properties can be used for this. So here's an example. Rental income received as a secondary source of income. The personal bank statement programs may be able to qualify the mortgage, and borrowers must provide bank statements within regular income deposits for past 3 months. So the rental income will then be used at 75% of the current lease minus the full mortgage payment, which includes principal, interest, taxes, and insurance, and if there's an HOA. And it must be in US dollars. So rental income requirements, bank statement verification, reflecting deposits, must 3 months. Deposits in an account that's not being used for income qualification purposes. This is that calculation, as I had mentioned. And then, of course, the currency requirement, as I had mentioned. So asset utilization, high income net worth buyers. So it's essentially using the buyer's assets, stocks, bonds, security as collateral to secure the loan. So the credit score goes down to 660. And this is lower than what many other programs allow. And one of the biggest things about the asset utilization is there's no liquidation requirement. Financial advisors tend to like this. Clients keep their assets in place, and we use it to qualify, right? So as long as they can verify the assets are real and have value, we can use them to determine the borrower's ability to repay the loan. The maximum loan to value is 80%. They can finance up to 80% of the value of the property that they're purchasing or refinancing. And it's a great way to help them get either an owner-occupied second home or investment properties. And this could be for 1 to 4 unit condos, non-warrantable condos as well. DSCR program. This one is increasingly important, or not important, but I say popular today. And this is the question that we like to pose. Have you ever worked with clients who've owned properties that generate a lot of cash flow, but may be able to qualify or may not be able to qualify for traditional loans based on their personal income? If so, have you considered DSCR loans as a potential financing solution? This is where this comes into play. So what is a DSCR loan? Debt service ratio loan. Experienced first-time investor options are available. The calculation of the cash flows available to pay rent obligations or debt obligations. It's designed for borrowers with properties that generate sufficient cash flow without having to supply personal income documentation. So the features down to 660 credit score. We actually have ways to get down to a 620, believe it or not. There's no income or employment verification. 80% loan to value max. Loan amounts, 100,000 up to 2 million, 1 to 4 unit properties, condos, non-warrantable condos, and investment properties only. So easy way to think of this one, in case if you're curious, is if you have a property, let's say, and the rent of the property is 5,000 a month, the mortgage PITA is 5,000 a month, that's a debt service ratio of 1, that qualifies, right? And this is what I was talking about, the DSCR breakdown. Gross rental income, total principal, interest, tax, insurance payments, that calculation, if they meet, that works. So we like to see it at 1% or higher, but there are programs that could go down to 0.75 in some cases. There are exceptions to go below that, but they have to qualify with what we call compensating factors. But this is a great way to help develop a real estate portfolio or rental portfolio. And so it is one of those programs I think is becoming more and more popular. So we're seeing, a lot of interest in developing passive income through real estate. It's one of those programs that just makes sense. And candidly, after we saw some loan level price adjustments, which are adjustments to conventional loans for buying an investment or second home for a lot of individuals, right? This happened in 2024. We're starting to see interest rates on DSCR loans kind of neck and neck with conventional home loans. So the popularity of this particular program is actually growing exponentially. So here's a scenario. A real estate investor is looking to purchase a rental property. Property has high operating expenses for the last couple of years, and the real estate investor seeks a loan to purchase that property. So the scenario is basically looking at the amount of income that they have, looking at what's received in rent, dividing one from the next to figure out what the DSCR score is. When you calculate that income, we'll use lease agreement or the market rent of the appraisal, whichever's less. And if there's no lease agreement, then the rental from the appraisal could be used. And the appraiser essentially does something called the Form 1007, which is a rental survey looking at comparable rental sales in that area to come up with that calculation. So, as a loan officer specializing in non-qualified mortgages, I definitely have the wherewithal to help you. If you have questions about anything about the non-QM landscape, I'm here to help. So feel free to reach out. I'm looking forward to partnering with you and offer your clients more financing options and potentially helping you close more transactions. If you have any questions about any of this stuff, know that I'm available. I'm a resource. I want you to call, text, or email me anytime. Feel free to visit me on social at mike.belfor on Instagram or Facebook, on YouTube. I think I'm on everything at this point. So yeah, feel free to reach out. Any questions that you have, of course, we'll open up to that now. And I'm going to stop recording so we can open up that. But if you are watching this and you're not here with us, simply shoot me a message. I'm here to help.